Welcome to the second episode of the Cash Flow Connections podcast. Today we have a great conversation with a very experienced operator in the value-add office space sector. In this episode, we discuss how to identify a property that has a significant amount of value-add potential. We also give an example of a property that appears to be significantly underperforming the market. When you look at some of the details, you find out there's some fundamental reasons why the property is set up to underperform. We also talk about market selection, which our guest has an interesting perspective on, as well as tenant selection. So, if you're interested in investing in value-add office, this episode is for you. Let's go ahead and get right to the interview. How's it going, everyone? Thanks for tuning in to today's podcast. Today we have Michael Episcope, who is a managing partner at Origin Investments. He's been an active real estate investor for more than 15 years and has overseen the acquisition and disposition of more than $1 billion of commercial real estate. He co-founded Origin Investments in 2007 as a vehicle to invest his personal capital in private real estate. Before forming Origin, Michael spent 15 years trading interest rate derivatives, and he was twice named one of the top 100 traders in the world by Trader Magazine. He retired from trading in 2005 and has since then focused his efforts on pursuing commercial real estate full-time. So the last time Michael and I spoke, we had originally booked about 30 minutes for our call, and new topics just kept coming up, and I was very interested in his perspective on a lot of different topics. So, Michael, thanks again for coming on the podcast today. I'm really looking forward to this episode.
Thanks for having me, Hunter.
Awesome. So just give us a little bit more about your background, your experience, how you really got started in real estate in general, and then office as well.
Yeah, sure. My foray into real estate was really as a young kid. I used to work with my grandfather in the summers, so that's how I got my first taste of it in my teenage years. That was great. And then I had my first career in commodities trading, and then got back into real estate when I was right around, I would say, 30 years old. Started more on the passive side, and then obviously got more active in it through Origin. But I've been investing for 25 years, 15 years in full-time real estate, and I have a master's in real estate from DePaul University as well. So I use that as a transition between careers, great opportunity, and it's been a fantastic journey.
Awesome. Okay. Well, today's topic is really on office and specifically value add office. So when it comes to this asset class, where do you find the sweet spot in terms of purchase price, number of tenants, number of square feet? What are you really looking for when you start to analyze an office deal?
Well, the sweet spot is really a function of the capital markets. So where we focus on are $10 to $40 million deals. We stay away from the large institutional capital. We also stay away from the high net worth capital. $10 to $40 million is an area that we find that has a lot of inefficiencies in the market. That is generally office properties from $100,000 to 100,000 square feet to 300,000 square feet in size. And we just see less competition at this end of the market. And our goal when we're looking at properties is we're de-risking them, is we're taking underperforming value-added properties, well-located properties, and adding value to them by increasing the NOI through capital improvement plans, by increasing occupancy, driving lease rates, unlocking trapped rents. And that's a strategy that we've been doing for 10 years. It's a time-tested strategy. A lot of people do it, and it's right down the fairway. But it's sort of a combination of core plus and value add. But as we say, we like to take core plus risk and get value add returns, or value add risk and get development like returns. And that's our goal with all of our investment properties.
Right, that makes sense. And so when you're looking at sizes of 100,000 square feet or more, how many typical tenants do you have in a typical building, or is the number of tenants a concern of yours?
It is definitely a factor. Is it a concern? Not as much. So we have buildings. We have two buildings, and I'll give an example. One is 300,000 square feet, and it's north of Charlotte. And that building has about 10 tenants. And then we have a building that we just acquired in the Cherry Creek area of Denver, and that's also 300,000 square feet, and that has 80 tenants in it. And it's a different management process for how you're going to manage those buildings, but the building is really, and the tenant makeup is going to be defined a lot by the market itself. So in Charlotte, where the building is located, that is much more big block tenant demand. So tenants looking for 50,000, 100,000 square feet, whereas in the Cherry Creek submarket, those are more 5,000 square foot tenants. It's not that we don't focus so much on tenant size or the number of tenants. I would say generally in our buildings, there's probably 8 to 20 tenants on average. So the Cherry Creek building is a little bit of an anomaly. But what we like about both of those opportunities was the fact that they're below market occupancy and then below market rents so we can drive bottom line in each of those properties. And that's what we look for, is more the story. Obviously, we have to have the manpower then to manage the building appropriately, but the strategies are a little bit different for how our asset managers then interact with the property managers at each of those buildings.
Got it. Got it. So you mentioned there the discrepancy between the occupancy of the buildings. What are some of the other discrepancies you look for to really indicate that a property is really underperforming?
So the biggest thing when we're looking at is the owner. We want to look at, is it truly an issue with the building, or is it an issue with the ownership or a solvable problem? And value add comes in all different shapes and sizes. Sometimes there are trapped rents. You see buildings today where rents have been put into place back in '08 and '09, that period, and 10-year leases in place because it really benefited the tenants of that time. We look for those situations. We look for capital-starved buildings. We look for buildings where there's an opportunity to create value, but for whatever reason, current ownership couldn't create that value. And our job, as I see it, is to stay away from traps and make sure that we're not walking into a building that is underperforming because it's functionally obsolescent. And there's a lot of examples for that, especially when you start looking at the older buildings. Parking ratios are a big thing. Well, assets of older buildings, the average square foot per employee was much higher. So your parking ratios used to be 2 to 1, 3 to 1, even 4 to 1. And today's tenants, they squeeze a lot more people into office buildings. So the parking requirements are 5 to 1, and you can't generally change the parking fields for these buildings without building or something being cost prohibitive. So we focus on the problems that can be solved and walking the building. And if it's an issue of lobbies and corridors and upgrading fitness centers, those things can be solved. But if it's functional obsolescence of the floor plates or the location of the building, which you obviously can't change, or it's access or visibility, we do a lot on the front end, on the due diligence side, to make sure that we get it right and that we are really looking for that value that can be unlocked by enhancing through different operational performance measures.
Interesting. So, of the problems that can be solved, because I like that you mentioned there's plenty of reasons that a building could be underperforming. That is something you wouldn't want to touch. So that makes total sense. As far as the problems that can be solved in your criteria, what do you find is the most common cause of this underperformance?
I would say that it's ownership. There are plenty of buildings that we walk into, so you have to have a thesis when you go into a building. And if your building is trading, let's say $23 a square foot in terms of the rental rate that it's demanding for the tenancy, and the market is 25, well, you can make the thesis that either A, it's ownership and there's some problem with there, or it's a problem with the building. So when we're doing due diligence and we're looking at the building itself, we have to differentiate between, is the building underperforming because it's just a lack of management or a lack of capital, or is it functionally obsolescent, the building? So as an example, we were just down in Atlanta recently, and we own a building in the central perimeter down there. Well, we were looking at a building across the street. We know the area well. We've owned there for several years. And when we walked the building, it became apparent that it was more not the management of the building, they were very good, but it was more the functionality of the building. It had no aesthetic qualities. You walk through, it was confusing to get around. The parking field was dislocated from the building. And so that was a building that, even though the comp set suggested that it was underperforming, it was really performing how it should have been performing. So in those cases, it's just about looking at the competitive set and making sure that you're challenging your thesis. But ownership is a big thing, and I have to tell you that amazing sometimes when you go in and buy a property just by hanging under new management onto the property, how there's a buzz that gets created in the market, and then going out to the brokerage community and letting them know that it's under new management and you have capital. And one of the best things I heard about most recently from somebody was that an A building is simply a building with an A owner. And I actually believe that A buildings are run by owners who really care and make a difference. And the owner can make a difference in tenants, retaining tenants, and then attracting new tenants and the upkeep of the building. So we put a lot of time and effort into making sure we get it right on the buy. But we see more often than not, it's either an institutional owner that owns a building that they shouldn't, or a high net worth who gets into trouble and they've checked out, something's happened, or a qualified owner who's just run out of capital and they can't execute the business plan.
So, Michael, look at some of the content you guys are putting out. I know that you're operating nationally. So, tell us a little bit about how you're able to pinpoint some of the markets that really have the opportunity to provide lucrative returns, and how you look at that from a macro perspective.
So, great question. We chose our markets over the last 10 years really based on economic data, looking at them from that standpoint. Where are the baby boomers moving to, the millennials? Where's growth happening? Because we operate in value-added real estate, and oftentimes we're buying real estate that isn't fully occupied, that might have occupancy of 60, 65%. So it all starts with demand, and demand is correlated to job population growth. Where are people moving to? Where are companies locating to? So the cities we're in happen to be 7 of the 8 cities happen to be in the top 15 growth markets. The other thing that we stay away from are really the cities, the coastal cities, so your primary cities, because the cap rates are just too low for us to be able to compete, or actually there's too much growth assumption when you're going to New York or Miami or Seattle or Los Angeles. They've done very well over the last couple of years, but we are very much about protecting and growing our capital. And no differently than the stock market, real estate acts in the same way. When the majority of your return is predicated on growth in the market and that growth is pulled away, you have extreme volatility. So in the markets we're in, which are Chicago, Denver, Austin, Houston, Dallas, Charlotte, Raleigh, and Atlanta, we see these as sort of the sweet spot, as the intersection between growth and value, still where have, again, top 15 growth markets, so they have that going for them. But they also have decent going in cap rates, so we can generate good levered yield on our equity. And it'd be like looking at the stock market and trying to pick a high growth stock but with low PE. In the public markets, it's very difficult to find that. But in the private markets, and one of the reasons why real estate is such a great investment avenue is because you can do it. That a manager, if you look at enough properties, you can find these diamonds in the rough where you can buy them at a price where you don't have to assume that 6 to 8% growth rates are going to happen, but you can implement those through a value-added plan. So we have sort of this hybrid strategy of picking our markets, working on local relationships. We have people in our markets, and then looking for the right properties where we can build demand. So we're big believers in having the winds at your back, because real estate is cyclical. And when it turns, we want to be in communities and areas where they will pick up, and that they're going to continue to have high job growth and high population growth.
From what I've seen, you guys are focusing on 8 major markets, and those are located all over the country, right? The growth markets in the US. Because these markets are located in multiple different states, you mentioned the management being a big cause of some of the problems of the properties that you purchase. What strategies do you implement to watch over those on-site property managers to guarantee that your purchase is going to go differently than the person you're buying it from?
Yeah, it's a great question. So we're hands-on, first of all. So we really have we keep a close eye on every single asset that we have. Our asset manager institutes regular reporting from each and every one of our property managers. So they have a call each and every week at every property. Certainly, your properties that are in the early stages of value add will need more attention than your properties that are in the later stages of value add. So we have a property, for example, in Dallas that is a single tenant. The value add there is below market rents, and we have to wait another couple of years before that tenant rolls over and that we can bring that property up to market value. Well, that doesn't take a lot of time for our asset manager, but a deal like Cherry Creek, where we have 80 tenants, takes a lot more. So working through that leasing plan, working through the value add strategy, the improvements, they're going to be in much tighter communication in the early stages than the later stages. The other thing that we do is that we have technology. So all of our property management reports are uploaded onto a system called Integratech, and we get to see a portfolio roll up and a view of not only how our properties are doing from an expense and revenue standpoint, but also how they're doing relative to the peer set. So we have instituted not only technology, but just making sure that we have the requisite manpower to be able to manage those. And the reason why a lot of individuals get into trouble in this asset class is because they start playing in another sandbox, that they lose sight of where their competitive advantages are and where their skill set is best used. So we have always focused on the $10 to $40 million projects, and that's what we're really, really good at, is that area. So we just have to be mindful as we grow not to leave this field, and we have no plans of doing so. But I think that's where a lot of these organizations get into trouble, is strategy drift. But that being said, we see all kinds of, we see partnership issues. We see people who are just in trouble because of some other event in their lives where they need to sell, where they don't have capital to put in tenants improvements, pay brokers, and it's that story we look for in every building about why is it underperforming and what can we do, and go in there and solve those problems that are causing it to be underperforming.
Cool. And you mentioned that you visited property in Atlanta, you immediately saw some problems that were pretty much unfixable. How often do you guys visit your properties, or do you see your properties prior to closing?
Oh, of course, yeah. So we have three deal professionals in their markets. So we have a boots on the ground strategy or regional. All of our team members on the ground, they have their region. So we have an office in Charlotte that covers Raleigh, Charlotte, and Atlanta. Then we have an office in Dallas that covers Dallas, Austin, and Houston. And then we have an office in Denver, and Denver office, from an acquisition standpoint, covers Denver and Chicago. And then our headquarters are also in Chicago. So prior to any deal being acquired, I will visit the property, my partner will visit the property, the asset manager visits the property, and certainly the local acquisition officer will be at the property as well. And several tours happen in the due diligence phase. We hire engineers, we hire brokers, we get opinions about the building, and again, it's really about just looking at your thesis and trying to disprove it and making sure that what you see as the reason for the property underperforming is the actual reason. We perform tenant interviews, but everything goes in those early days when you're acquiring the property, because the only thing really within your control is the price you pay. Everything else is an assumption after that day. So we spend an inordinate amount of time on the front end making sure that we get the price and all the due diligence correct. And the biggest thing that I think anybody can do in these is the tenant interview process, and making sure that you understand the tenants, you understand the desires, their needs, what's wrong with the building, what their intentions are to stay or to leave, and mitigate as much risk as possible on the front end.
Got it. When you go through this tenant interview process, are there any specific businesses that you guys are very interested in owning properties where there are specific tenants in these buildings? Are there any tenant types that you want to stay away from?
So we would always stay away from startup companies, companies with no credit. There are always exceptions to the rule if they somehow enhance their credit. Technology companies are very difficult. They have high growth, but they also have short lifespans. So with technology companies, let's just say the average life is 2 to 3 years, and if they do survive beyond that, they're going to generally outgrow your building. So those are more difficult. I would say that the ideal tenant for us is a stable tenant, been there a long time in a growing industry, who probably, if they need to expand, it's only by a little bit, but they're not contracting and expanding and don't have a volatile business model. we really, when we underwrite real estate, it's about the concentration risk within that real estate and underwriting that key tenant. So we're operating in the multi-tenant office side. Generally, we don't have tenants who have more than 30% of the gross leasable area, but to the extent that they're 10%, 20%, 30%, we will spend a lot of time underwriting the credit, making sure that we understand everything about that tenant and uncovering as much as we can during the tenant interview. But as you can imagine, public companies are easy to underwrite from credit side. Private companies are a little more challenging, but we can usually get balance sheet and income statement information from those companies through the process to get a better idea of what their credit looks like.
Got it. So earlier you mentioned two of the main strategies that are really kind of on the low risk spectrum of things, which is raising rents, increasing occupancies to market levels. Are there other strategies? Do you implement value add strategies that require significant capital expenditure? For example, are you buying office that's B class office and converting it to A class?
We don't do full repositionings. Again, what we're doing are mostly light value add properties. So we would go in and look at properties. We want to focus on the revenue generating value add components. So we will look at redoing lobbies, we will look at redoing bathrooms, at corridors, at elevators, and all of those things that make the property really more appealing and drive demand to the piece of real estate. So that's what we focus on, but we don't do large repositionings where we have to build extra wings. Those risks tend to be more binomial in nature, and we're trying to keep our risk profile extremely low and work on the things that we're good at and that we know work. Adding things like fitness centers and being able to create an amenity-rich building that retains tenants and attracts new ones is really important.
That makes total sense. It's something you've repeated several times, and it's in different ways, and it's completely in line with my perspective as an investor as well, which is that from a risk-adjusted basis, everything should be viewed through that lens because anyone can acquire an 18% IRR, right? It's just a matter of what risks are you taking on in order to receive that IRR, and especially when you come with processes or strategies like additional square footage or doing a massive reposition, not only is there a significant amount of capital expenditure required to implement those strategies, there's a ton of uncertainty that goes along with that process. So if it requires licensing, if it requires changing in zoning requirements or plan specific changes, there are always uncertainties. It's very unpredictable and, like you said, binomial in terms of the results. So I agree with that. I agree with that strategy a lot. And you can still achieve very lucrative returns without incurring those type of risks. So one of the things that we look at obviously is going to be lease renewal rates as well as the lease terms. What's your typical hold time for a property like this, and how does that factor into the way that you look at lease renewals?
Well, in terms of, so think about an office property. It's a little bit of a puzzle. So going in, a lot of times, the reason why we may be getting a good price is because the last owner did an awful job of staggering lease renewals. So you might have in year 2 or 3 that 40 or 50% of your leases are expiring. We will take that risk of those expiring leases. And what we do, and I think what we're really good at, is taking that then and reconfiguring that lease duration so that it is more stable throughout the hold period. Because when you think about value that's created in real estate, you're going to create a lot of revenue through increased occupancy. You're also going to create lease rate. But the stability of the cash flow is created through credit and duration. And by really focusing, once you own that asset, on the duration of that lease and good quality tenants so that you have a stable cash flow, you're de-risking that asset so that when you bring it out to the market for sale, you are going to attract capital buyers who have a much lower cost of capital. So we love those opportunities where we have good real estate, but there's a broken structure inside because, as I mentioned before, those are things that can be solved with the right capital, the right patience, and somebody along the way probably wasn't thinking, or they may have just been in a spot where they weren't able to negotiate a lease that's staggered in a way that's beneficial to the property itself, and that can really destroy a lot of value. If you have concentrated lease rollover in 1 or 2 years, that can really hamper value of a property. So, the whole period is really going to depend on how quickly we can add value to the property, how quickly we can get to the leases in there to the maximum rollover. So if we have a property where we buy today and the majority of leases don't roll until year 4 or 5, well, then we're going to hold that property till at least that period. But if we have a property that is 60% occupied today and we're getting our entire value proposition from getting it from 60 to 85% occupied, then it could be that we just hold that for 2 years. But in general, all of our properties have about a 5-year business plan, and we create investment value through both appreciation and cash flow. But that being said, we've never held a property for more than 5 years, and most of our hold period is about 3 to 4 years. We do have a property right now in Fund 3 where most of the rollover happens in 5 years, which is fine with us because it's more of a core plus risk where we believe we're getting outside returns for holding, and there's not a whole lot of management that has to happen in that property. We're just collecting rents for a few years until that rollover happens and watching the rents rise in the market around us. It's a good position to be in.
Absolutely. So earlier you mentioned limiting the amount of exposure you have to capital expenditure. What are some of the other strategies you use to protect investors from downside risk and reduction of capital?
So you obviously know this too. I mean, investing is all about managing downside risk, and there are hundreds of assumptions that go into a model, and most of them won't be right. And as I said before, the only thing that you have in your control is the price you pay for a piece of real estate. Everything the next day is an assumption. How much occupancy you're going to get, the price you're going to pay, whether or not your tenants retain, they stay, how they're going to behave. So there's a lot that goes in on the front end. And as I said before, about making sure that we're buying underperforming properties that are underperforming for reasons of which we can solve. That's number one. So we're positioning ourselves in higher quality real estate and then leveraging it responsibly. So we typically leverage office to about 65%, but I've told this to other people, there are times that 50% leverage is too much, and there's times that 80% leverage is responsible. And it's not about a number, it's more about matching the leverage to the business plan and making sure that your leverage can withstand some of the stress tests within your model. And the thing about office that really, when you look at it from a financial modeling perspective, it looks incredibly smooth. And that's because when we model real estate, we're using assumptions and we're using probability analysis. So in all financial models out there, when it comes to looking at office, you're assuming that there's a 65 to 70% renewal rate of your tenant. And when you look at this across 20, 30 tenants in your portfolio, you will have somewhat smooth. But the reality is the tenant either renews or they don't. It's binomial in nature. And so what we do is when we model these things, we have a model that assumes probability analysis. And then we have another model when we're right-sizing the debt and looking at it from that standpoint. Where is our risk, and what happens if these 2 or 3 tenants do not renew? They might be those 10%, 20% tenants that I talk about, and can we cover cash flow at the end of the day? So we do a lot on the stress testing. And the last thing I'll say, when it comes to just the asset itself, we exit when it's appropriate. We underwrite to 5 years, but again, we've never held an asset for 5 years. We exit when we've maximized value and when somebody else is willing to pay us a price where we would no longer buy it at. And that's the simple strategy that we've always followed. We love investment returns. We're not falling in love with real estate, and we don't hold things longer than we should. And I would say as a company, a few things that really help our investors get comfortable is that we invest a tremendous amount of capital side by side with our investors. My partner and I are the largest investors at our firm. We always have been. I hope we always will be. And then in terms of things that we know and things that we don't know, well, in the world of, let's say, interest rates and cap rates, well, we can all disagree on where they're going or have that argument or anything, but I think we can all agree with the idea that the risk to real estate is a rising interest rate market. So in all of our deals, we make sure that every deal out there has the LIBOR curve written into it so that we see higher interest rates in the future when we go to refinance, when we go to sell. And we do the same thing with cap rates as well. And these are some nuances within the institutional underwriting world that we adhere to ourselves. And I don't know that every manager out there does, but when you buy today and cap rates are 6% in the market, the risk is that they're going to go up. So our exit cap rate in 4 or 5 years is going to be a 6.5, 6.75, 7, and all of our models withstand higher cap rates in the future, so that if they do go up, we can achieve our business plan, and if they go down, then that benefits everybody. I had a professor tell me a long time ago, which I always adhere to, said, take care of the downside and the upside is going to take care of itself. And I think what we are really good at here is risk management and making sure that we're always protecting our capital and growing it and putting ourselves in a position to win. And the last thing we do as a firm is that the way our team is compensated is that everybody is incentivized by investment performance. So we have created a collaborative environment that doesn't really allow people or incentivize anybody to bring bad deals to the table. It only hurts the team and it hurts each one of them, because if one deal in our fund goes wrong, then it really impacts everybody in that fund. So it's something that my partner and I implemented when we started the firm, something we felt strongly about aligning the interests of everybody in our firm with everybody outside our firm, our investment partners. And so all of those ways are some of the small details about the way we protect our capital and also the capital of our investment partners.
Man, that's a great answer. You touched on several things there that are just very critical. I really like your explanation of the binomial outcome of something that's projected to happen 65, 70% of the time, most notably lease renewals. Either they will or they will not renew. And so you have to be prepared for that from a sensitivity analysis perspective, but also emotionally, right? You have to be prepared that that may take place, and you have to be prepared structurally in the sense that you must have other alternatives available. Also, you mentioned the discussion about the cap rate expansion versus compression. For the listeners out there that are looking at new opportunities, to Michael's point, right now it's very important that underwriting assumptions allow for cap rate expansions to take place during the performance of the purchase, whether it be 5 or even 10 years, because of where we are in the cycle. So speaking of that, in the markets you're looking at, you mentioned Denver, you mentioned Chicago, Austin, Charlotte, I believe. What is kind of the range in terms of the cost per square foot in markets like that?
It's a little bit all over the map. It's kind of between $100 and $200 per square foot, and that's going to depend on vintage, that's going to depend on occupancy, that's going to depend on credit quality, that's going to depend on the competition, the location of the building. So there's a lot that goes in to the square foot, but generally the stuff we're looking at is between 130 and 170 per square foot, and the upper and lower range would be about $100 to $200 per square foot. And at $200 per square foot, the one thing, especially when you're dealing with buildings that are 10 to 15 years in age, we never had this discussion back in 2011, 12, 13, but when we're buying a building at 180 and 190 a square foot and our exit price might be 210, 220, we have to start being concerned about replacement cost in the market. So that's something that is very different today than was 3 or 4 years ago. Replacement cost never came up in our discussions a few years ago, but as we've seen asset prices continue to improve and move up, we're seeing that much more in the discussions we're having and making sure that we are still 20% to 30% below what new construction costs are in the market today.
Awesome. So that's a good rule of thumb there for your expectations. And in terms of cap rates, what are you seeing in those markets? If it's 130 to 170 per square foot, what are you seeing in terms of cap rates in those same deals?
So a stabilized cap rate in our market is anywhere from, call it 6% to 8%. And again, it's going to vary substantially on the location, on the credit, on the duration, a lot of things, and tenant office. But going in cap rates are somewhat irrelevant in the value add multi-tenant office sector. And just as an example, if you have a building that's 60% occupied and it has a break-even NOI, your cap rate is going to be zero. That doesn't mean that it's a bad building, and you can also have a building that is a 15 cap but with a single tenant occupancy with the tenant who's going to vacate the building in a year. So you can't really tell the difference between which is a better deal there at the end of the day. So what we use as our metric is what is called return on cost in the value add world. And all that means is that is your cap rate a few years out. So putting money into the property, how much are you building the NOI to? And then it's your NOI divided by your all-in cost basis that tends to be 2 or 3 years out. And what we try to do in value-add real estate is we're building a spread. So if that current cap rates today are 6%, we want to build a spread of 150 to 200 basis points between what current cap rates are and where our NOI will be in the future. And it's that spread that creates value. And it's also that spread that protects downside. So as I talked about before, if your cap rates move up to 7, but you've built a spread or a cushion and enough NOI, you will still be able to make money or at least break even on your sale price. And that's really one of the things that we love about the value add sector is being able to build and create real value in your asset and protect yourself from downside shocks.
Got it. In the mentioned markets that you mentioned earlier, a lot of them are incredibly hot right now, especially since 2013 or so. And granted, a lot of them have had a lot of success, and you've been investing in these markets for quite some time because your market selection process has been spot on. So how are you able to continually buy in these markets? You mentioned Dallas earlier. They've seen massive increases in prices from about $80 a square foot to about $145 a square foot since 2013. How are you still able to see good deals and be confident in your buy there?
So starting with the macro, yes, we're in 8 markets around the country. So we're in Chicago, Denver, Austin, Houston, Dallas, Charlotte, Raleigh, and Atlanta. And all of our markets have been chosen based on macroeconomics and growth, where the millennials going, where the baby boomers, because ultimately you need demand. And real estate, especially in the office sector, is highly correlated to population job growth. But the other thing about real estate is that it's a relationship-based industry, that it really is local. It's block by block, building by building, and you can have a market that is going incredibly well, but then have a property where you have a tenant go bankrupt and you're doing awful. So the opposite can also happen where you can make money in a down market if the overall economy isn't doing well. So we look at it much more as the idiosyncratic risk around the individual property, and I'm not as concerned about price where we are in terms of absolute dollar value, 80 versus 130, 140 a square foot. What we look for is good relative value. So think about the stock market. It's 19,000 today, or somewhere around there, and that's a fact, and we can't argue that. What we can argue is maybe which direction it is going. And so if you were able to buy the stock market at 18,000, a nice edge to the market, you would do that. Well, that's what we look for. You can't do that in the public markets, but you can do that in the private markets. And there's a big difference between price and value. And we see and look at a lot of deals so that we can find the ones that have an edge, have a great story that we can uncover, and then build that value. An example is we just you mentioned Dallas. Well, we just acquired an asset in Dallas called Lee Park. This is in the uptown market of downtown Dallas. It's probably one of the hottest markets in the country, cranes everywhere, 90% occupancy on the office side. Well, this happened to be a deal that was lagging the market, underperforming. And it was underperforming because of ownership. It was owned by a consortium of high net worth individuals who were exposed to the energy sector. We acquired this because of a relationship on an off-market basis, got into the building at a great price. And it has all the qualities we look for in the building. Well located, it's about 65% occupied. And by just hanging the new sign under new management and letting the brokerage community know, we've had a lot of success already in the first 3 months of ownership. So we look for those buildings that have a story, idiosyncratic risk. And this is a deal that I would buy into. I mean, if I saw this deal in 2009, I would buy it at the same price with the same story. So we are still seeing deals out there. They're not certainly falling off the tree like they were in 11 and 12, but we have a lot of manpower on the streets, and we see more than 1,000 deals a year. We're selective about what we buy, but we see a lot of deals. And we take second and third place, and that's okay. But when we find a deal like Lee Park, it makes it all worth it. So it's a lot about just making sure that you have the manpower, the volume, that you understand the stories out there, and that you have a good relationship with the people on the ground who are in the know and who have the deal flow.
I think that's a great answer, especially mentioning the team you have in place, which creates the volume, which allows you to see all the deals so you can really pick out the sweet ones. I think that's one of the reoccurring themes that keeps coming up in real estate, is that your network is really going to define your net worth, and it really becomes important in the late stages of the cycle, because if you're able to see a lot of deals, you're able to be picky and you're able to allocate capital, but you're still able to get those solid returns without exposing investors to unnecessary risk. So that's a great answer to that question. So in your career, for the closing questions, in your career in real estate, what is something you wish you had done differently or something you had learned earlier?
Wow, great question. I don't know that I do anything differently. I've certainly made my share of mistakes, but I do think that defines who we are today and really helps shape our decision making going forward. So maybe I wish they weren't as many, but I don't think I'd do anything differently. And I remember a couple of years ago, I watched the Steve Jobs commencement, and he talked about how in life we do things and we connect these dots. And I'm not sure if you've seen that, but it's a great speech. And we do things and we have experiences in life, and we don't know how they come back, but they do eventually, and they help us become better decision makers. And when we're faced with that decision, or just in the future, we'll make better decisions. So I don't really regret anything, and I wish I had the magic answer for what I do differently, but really happy with the firm that we've been able to create and everything that's happened, and I think that it's been a good run.
Yeah, it's been a great run, especially since 2007, being the founding of Origin. What are you most looking forward to for the future, 2017 and beyond?
Well, 2017, I think just in general, just continuing to build and grow Origin and deliver a great product to our base of partners. We've grown substantially in the last year and a half. We're continuing growth mode. We're launching a new income product later this year, which we have not announced yet, but just continuing to provide opportunities to our investment partners and our people within Origin.
Awesome. Okay, well, I think that's a great note to end it on. Michael, I really appreciate you coming on the program. We learned a lot today about value add office. I know that you're knowledgeable about a bunch of different topics on this topic, so definitely want to have you back again some point. Thanks again for coming on.
Thank you, Hunter.
For all the listeners out there, I hope you really enjoyed that conversation. If you haven't yet subscribed to this podcast in iTunes, please do so right now. You'll get the episodes automatically directed straight to your phone so you can listen to them at your convenience. Just search for Cashflow Connections in the podcast app on your iPhone. And if you enjoy the program, please do us a favor and rate the podcast in iTunes. This will give us more traffic, more listeners, and it will make it easier for us to keep giving you great quality guests like the one we talked to today, which will provide more content for you. Thanks a lot.